Howdy, Jacob here. Today we're looking at Deluxe Corporation, and let's start looking into it. So, 6.38% dividend yield looks pretty enticing. We got a lot of debt, net debt here, 821 million market cap with 2.3 billion enterprise value. Let's start looking at that. 1.6 billion long-term debt. I'm assuming they funded an acquisition here with this big jump. And it was. Okay, so I mean, they have 100. Let's be generous. Let's give them 100 million here, and they have over 16 times that in debt. Really don't like to see that. I don't like that. They went in debt 155 million dollars to pay for this acquisition. Um, maybe it'll work out in the long run, but in the short term, right now we're seeing a lot of capital expenditures and not much better in on the property plant equip. Not much better in the cash from operations side. So I think we can already set some assumptions here. So pretty consistent growth outside of COVID. These 12 and 10 looks like it just because it was rushing to get back to normalcy. Um, Man, the business was so different 2017 to now. Look at this. 16, 16, 17, 15, 14% return on invested capital, and now we're looking at 3%. So it could be one of those things. If it gets back to normal, I'm thinking maybe this is like a Disney play where they had to shut down the park, shut down the cruises, and it doesn't look like the same business. Can they get back to it? I don't know. Let's look at on the gross margins side, 60 low 60s to mid to low 50s. All right, sorry. Let's get making some assumptions here. So might be conservative, say 3% on the revenue growth side, 13 on the PE and price free cash flow, and then instead of 15, I'm gonna do 17.5 since their long term debt is well over 16 on their last few years free cash flow. Um, I might just do an average, say, maybe they don't get back to normal, but they get close to it. What's that? 4 and 9. Maybe I'll do 5 and 8, maybe. Um, Looks like they were buying back shares too, and then they stopped doing that. It is a completely different business. What happened? Man, that's tough. Just from looking at history, that's interesting. But 1.2 million, or sorry, $1.20 in as their dividends, paying out 50 million. I mean, they can afford that. Like that's fine. I'm not gonna increase it, but I'm not gonna increase it, but um, I think that's a reasonable dividend. So I don't think they have to do too much outside of that. I think if they're pay out 50 million, I think the rest they have to take down some of that debt. So it's pretty hefty. Um, all right, so let's go share change. I mean, recently it's been a lot different, but let's say let's say 2% here. I'm gonna change these um, margins. I don't like that. I'm gonna do closer to over here. Let's do 4 and 6 because the business changed. I mean, we got. I want to look at it to see what changed to see if they can actually get back to some of those numbers that are normal. But let's see what. I mean, it's not too far off. What do we have here? 21%. That's pretty reasonable. So I really like to look into this. If it gets to within 10%, I'll try to do a deeper dive on it. See if these assumptions make sense. See what I would change. But for now, I mean, yeah, I want that extra return because a lot of debt. These margins, I have absolutely no idea. The business changed so much pre and post COVID. This would definitely be a company I'd want to look into the quarterly reports to see in their 10Ks, 10Qs to see if these are all reasonable. But for now, I'm just waiting. Ain't no worry with that. And I hope everyone has a good rest of their day. Thank you.